Alrighty, to kind of recap where we've been so far, we started out with a hypothetical example. You and your sibling putting a bucket of money by the door and kind of contributing to that bucket so you would have a place to keep your money when you go out on Friday, Saturday night to be able to take money out of that bucket and go out and have fun. We said there were three main things that you would need to know about that bucket of money: how much money is in the bucket at any time, how much of it belongs to you, and how much of it belongs to your sibling. That is what our accounting system is set up to do. In the second video, we talked about a simple accounting system that had stuff on one side and claims to stuff on the other. And we talked about how every time we put money into the bucket or take money out of it, we make two entries, and that keeps our little accounting system in balance at all times. So now we're going to talk about a report that kind of summarizes the three questions that we talked about in video number one. That report is called the balance sheet. And every business has a balance sheet. And the whole idea behind the balance sheet is to help us keep track of what stuff we have and who has a claim to that stuff. So you can see I've got a simple balance sheet set up here for our money bucket. I have stuff, I have claims to stuff, and then below that I've listed all the different accounts that we have. So the only stuff we have right now is our bucket full of money. And according to our second video, if we look at all the money that came in and went out, it looks like we have an ending balance of 50, 45, 35, $55. So the ending balance in our bucket, according to our example, was 55 bucks. So on our balance sheet, we would show cash of $55. We have no other stuff in this example. Later on, we'll talk about equipment and property and vehicles and all that stuff, and we could add that into our stuff account. But right now, all we have is cash, and there's a total cash amount of 55. So our total stuff is $55. Now, the reason they call it a balance sheet is because this part is going to equal that part. It's going to balance. So our stuff is going to equal claims to stuff. Dad's claim in our example, he loaned the bucket 20 bucks at the very end, so his claim is going to be 20. Our sibling had $10 in the bucket, and we ended up with 25 in the bucket. And again, I got those numbers from our second video. Dad's claim was 20. He loaned us 20 bucks. We didn't pay him back anything yet. My claim started with nothing. I put in 35 and I took out 10. I'm left with $25 worth of a claim. And sibling put in 15 and took out 5. They're left with 10. So really all our balance sheet is doing, gang, is it's taking the ending balances of these accounts and just kind of keeping track of them, kind of summarizing for us. So $55 of total stuff. Our claims to stuff were 20, 10, and 25. If I add those together, I get total claims to stuff of $55. So the way you can kind of check your balance sheet, you have to make sure your stuff line, your total stuff, equals the total claims to stuff. 55 and 55, so we do equal. Our balance sheet is good. So that report, and you will do a whole lot of different balance sheets as we go along, and there'll be a little bit more involved in that. But essentially, the idea of the balance sheet is simply to kind of show us what we own and who has a claim to it. And that's what that report answers. In our next video, we're going to start substituting some of the generic terminology like stuff and claims to stuff with actual accounting terminology. So continue on if you'd like to take a look at that.